There's a couple of things that we need to be aware of going into next year. And this is the problem with the vast majority of analysis that I read. The vast majority of analysis I read is either A or B. It's either next year is going to be a continuation of the bull rally, don't worry about a thing, just stay fully invested, or it's the end of the world. Next year, interest rates are going to the moon, the markets are going to crash, and everything's going to be terrible. So you better be in cash or gold or whatever somebody's trying to hawk you. What we need as investors is just a balanced outlook for next year, saying, hey, here's the positives and the negatives. These are opposing forces that occur in every market. They exist at all times. And one narrative is just winning out over the other for the moment. That's all that occurs in the markets. You've got buyers and sellers. They both believe they're right. It just depends on which group is winning the battle at the moment. So going into next year, this is what we need to be focused on. So from the bullish perspective, there's actually some decent things to help support the market. From the bearish perspective, there's also some things you need to be cautious of. Now, here's the interesting thing about this. It doesn't mean you can't have both in the same year. From the bullish case, first of all, you've got an increase in liquidity coming. So the Federal Reserve is going to cut rates. So we got the FOMC meeting this week. They're going to cut rates again. They're likely going to cut rates again in March. Economic growth is certainly supportive of that. And of course, there's some liquidity stress at the banks. In fact, it's expected that the Fed is going to buy about $40 billion worth of short-term treasury bills this month. So going into next year, that liquidity support is going to be important for the bulls. Secondly, regardless of what you think, we're in a bull market and we're not in a recession. When the Fed cuts rates and you're not in a recession, markets tend to do better because you're giving more liquidity and accommodation in a non-recessionary environment. So that leads to more speculative activity, leads to a little bit stronger economic growth. If you take a look historically, when there's no recession, stocks tend to perform better in that environment. So if we've got the Fed cutting rates going into next year and there's liquidity support, you have the basis for a stronger market outcome at the beginning of the year. Also, consumer credit. Yes, there's certainly concerns about delinquency rates. There's concerns about the student loan delinquencies and auto loan delinquencies, but consumer credit's still expanding, and consumer credit's important to the overall economy because that's where buying power comes from. That expansion of credit is supportive for economic growth. And so, of course, when I'm buying something, I'm creating revenue for the companies in the S&P 500, which improves their earnings. That helps support the markets. So again, we do see some stress in the market, but we're not seeing widespread stress yet. It's definitely not great, but we're not in a recession yet. Data right now remains supportive of higher asset prices, at least in the near term.
Catch me daily on The Real Investment Show. The link is in the description.